Hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video installment, we're going to talk about creating and leaving a legacy. Really important area, and this was from a recent presentation that we did for clients at a lunch and learn that we hosted. And so creating and leaving a legacy is one of those topics where over time, as people get involved in their communities, have causes that are really important to them, they begin turning their attention to how can I make this a much more intentional strategy that could last long after I'm gone from this planet. So it's about creating and perpetuating ongoing legacy in perpetuity for organizations and various services and charities that are important. So let's talk about this. A really important part of the overall wealth planning discussions. So this particular schematic just has the typical discussion points we have with clients. Risk management's at the bottom. Before we even talk about significant legacy planning, we want to make sure that the client has sufficient life insurance to look after dependents, disability coverage, critical illness coverage in some situations, have been aggressively paying down debt, and have emergency savings. So the basics are looked after. Once you're well on your track to looking after the basics, then we get into the whole topic of income security. And income security really is talking about retirement income security. So how much do I have to save in my RSP accounts, my pension plans, my tax-free savings accounts, or my open investment accounts to make sure I have ongoing security over my lifetime. And then once you've done that, once your basic risk management and income security goals are looked after and you have a plan in place, then you can begin turning your attention to legacy. And it's probably one of the most satisfying planning areas because study after study has proven that as people focus away from themselves and look at making a difference in the lives of other people around them and their communities, there's a huge sense of satisfaction and fulfillment that comes out of that exercise. Now, when we walk through a discussion on legacy planning with our own clients, it usually emerges out of this discussion. I love the financial roadmap. And what the financial roadmap does is at the bottom left-hand quadrant, we talk about the client's current situation, where they need to be financially down the road to reach their goals. We begin to identify milestones, which are specific goals with usually dollar amounts attached with timelines like I want to retire at age 60 and here's the income I want, and here's how I want to cope with inflation in terms of that income. It might be recreational property down the road, and it could even be legacy planning. As we go along this financial journey, this roadmap, we eventually hit this staircase, and the staircase really is about what's important about money to you. And it's never saving taxes, getting better investment returns, or buying toys. That's important, but really ultimately it's about values. So often I hear people say peace of mind, security, making a difference, helping the grandkids, helping the kids, leaving a legacy. Those are the kinds of things that come up often when we have this discussion. So the whole legacy discussion flows out of the discussion around values and how you want to use your money to perpetuate those values. So let's take a look a little bit at the giving landscape. This is from a study that was done back in 2010. But at that point, there was 84% of Canadians donated in some way. Now, when they used donation, it was kind of a looser donation description that what many people would use. So most people think in terms of actual dollar amounts, but they were looking at dollars given to organizations, gifts in kind, so it could have been food drives, that kind of thing, and of course giving in terms of time. The average annual gift by Canadian donors was about $446, and about $10.6 billion was donated annually. So the whole giving landscape is a very significant component of what happens in terms of the nonprofit sector. And there's a few other anecdotes that I want to share with you around the gifting area. There is a really interesting article in April 2018 in Maclean's magazine. And the magazine article was having a discussion with David Johnston, who was a former Governor General in Canada. And he was lamenting the fact that giving levels have been deteriorating over the years. So, basic giving, when you adjust for inflation, has actually been on the decline for a number of years. What's happening is that those that give are in general giving more. But what we have seen is if you look at tax files since 1990, the number of people that give, and it's obviously tracked to the tax returns, has dropped by more than a third since 1990. So it's really important when we talk about giving. We'll talk about in a minute why the giving landscape is going to be so critical to our Canadian society over the next many years, and we really do need to encourage philanthropy and a giving mentality. We do know that with age, people do give more. In terms of participation, although men in total give more, women have a higher participation rate when it comes to giving. We also know that giving patterns are such that it's fairly concentrated. The top donors in terms of giving contribute roughly 83% of the total gifts that are given. So that's a little bit about the landscape. What I want to do, though, more specifically, is kind of talk about why this is important, what the trends lines are economically in this country, and why giving will become increasingly important in our Canadian society. So let's take a look at that. So when we look at giving, why would we consider legacy planning as part of an overall financial plan or wealth plan? So you can see here I've just written a few things. You want to give back. So some people are just intrinsically motivated to want to give back. You often hear about people maybe who have been new immigrants to this country, or their family came from other countries, and they really prospered, and they feel a need to give back to the community that had given so much to them. Another reason is legacy for the community. In other words, if you are giving already to various organizations or foundations or whatever the giving pattern is, for a lot of people, they don't want that giving to end when they're gone. And so that's not everyone, but a lot of people who've been giving to organizations that are really important to them, they want to perpetuate that giving past their life. And so that would be another reason for looking at as part of your plan. And then concern about government funding, and I think that this will increasingly be an important area as governments come under pressure from a taxation standpoint, a revenue standpoint, expense standpoint. It's going to be more and more difficult for governments to, lean into funding various programs that might be needed. So we live in a country where the social safety net and government programs have been almost sort of part of the DNA of Canadians. But as you'll see in a minute, that DNA is going to be stressed a little bit because of the financial difficulties that might be coming our way. So this chart looks at projected increases in public health care spending, and the chart comes from OECD data, and it looks at trend lines. And really what you see is the total effects from aging. So on this chart, if you look at spending levels as a percentage of GDP, those levels will continue to increase on the brown here just because of basic demographic trends. We have an aging population. But then in addition to that, because of technology, the increasing costs of technology, also the expectations of people. So as people get better and better health care, they expect that better health care will continue through the whole life expectancy. So not only are costs increasing, but expectations about the kind of services that will be delivered. So this chart just basically shows you that there's going to be dramatic pressure over the next number of years on the healthcare system. And one of the stressors here obviously is how are governments be able to fund this. So at the same time that public healthcare is going to be costing more, we're going to see other stressors, whether it's the pension system as an example, and other areas that will cost more. This is Canada's fiscal squeeze in historical perspective. This is a great chart. And so Fraser Institute put it out, but what it does, it looks at total revenues by government, and then it looks at the expenditure trends. And you can see that going through the last number of years, we were running consistent deficits in government. And then back in the late 1990s into early 2000s, we saw a reversion back to balanced budgets. And in fact, through the conservative government years federally, we saw some surpluses pretty consistently. Those surpluses were being allocated back to some debt. We hit a period here where you can see in 2008 there was a financial crisis that took place globally, and federal government expenditures increased, their revenues declined, and we were running deficits. And then within a couple of years, they had, a few years had righted the financial ship. So we were right at the point of breaking even in terms of our expenditure and income patterns for government, and so when that happened, that was great. The trend line was going in the right direction. Then we had a federal election in 2015, and the deficits have been ballooning quite significantly. Now, the reason that I go over this is that when we look at the nonprofit sector, we think it's going to come under increasing pressure because governments are going to be constrained in their ability to give money through various programs to people that really need it. And that's why the philanthropic donor sort of area is going to become very, very important. And it shouldn't just be for the wealthy. All Canadians should be concerned and should be building in, I think, some level of giving into their financial patterns. Okay, so let's just take a look at the tax or deduction side of donations. The federal charitable tax credit is 15% on the first $200 of donations and 29% on the remaining amount. The federal tax credit on $400, as an example, is 15% on the 200 plus 29% on the next 200, which would be $88 as an example. So there's the basic numbers, and you can claim up to 75% of your net income in any given year. In the province of Manitoba, where we reside, it's 11.8% on the first $200 and 17.4% as a credit on any donations above $200. This is a non-refundable tax credit, and as such it can only be used to reduce tax owed. If you don't owe any tax, you don't get a refund, but you can kind of carry it forward. So you can carry forward unused donations for up to 5 years. You can gift securities on an in-kind basis without triggering deemed disposition for tax purposes. In other words, no capital gains trigger. And this is really a powerful one. So if you've got securities, stock as an example, that has a fairly large unrealized capital gain, and you're trying to find ways of initiating donations to a charity or a foundation, you can actually take that money. Let's say that you paid $10,000 for the stock. It's now worth $20,000. It has a $10,000 capital gain. So normally if you sold the stock, you'd have a $10,000 gain, 50% or $5,000 would be taxable. You might have, let's say, a couple $1,000s of tax that would get triggered. What you can do is take that same stock, move that $20,000 across to your charity. It does not trigger a capital gain, and then charities will often have a facility in place where they can sell that stock, raise the cash, and use that money for the charity. Another powerful area is up to 100% of taxpayers' net income can be claimed as donations in the year of death and the year preceding the death for the purpose of calculating charitable donations. So bottom line on that one is you can make very significant gifts in the year of death tax filing, such that you could have CRA taken out almost completely from your year of death tax return. So when people die, RIF accounts, tax deferred accounts all come in as regular income. Any unrealized gains on property or stock come in as gains. So for those people that are motivated from a donor standpoint, philanthropy standpoint, there's some significant tax planning opportunities to reduce that tax bill upon death. Okay, so what are the main ways that we can give? Well, we can give gifts of cash, which is probably one of the most common ways. So an awful lot of money gets given in $10 and $15 and $20 in checks for sort of ad hoc gifting that goes on door-to-door solicitation for charities. Gifts of publicly traded securities. So again, we talked about that. So investors can take stock, publicly traded securities, and gift that to the organization. It doesn't trigger a capital gain, and then the organization or charity can sell the stock. Bequests, very common. So through your will, you can make a bequest and a gift to the charity. And you can even list your on your RSPs, RIFs, TFSAs, you can make donations and list charities as beneficiaries as well. And then finally, gifts of life insurance can be a way that you can give money to charities. What I'd like to talk to you a little bit about is an emerging area of gifting, and with Asante, we've got the Asante Charitable Giving Program. And the main advantages of these gifting programs is essentially you're able to set up what acts like your own foundation. It makes the overall aspiration to give much more structured and increases the probability that that structure might be around in perpetuity. So it's efficient. We'll talk about that. You maintain ongoing control. There is immediate tax savings, but there's no requirement that you gift all that money to the charity right away. So there'd be maybe some reasons you'd want to defer that. and you can create ongoing legacy. So in terms of how it works, let's just take a look at the main steps. So they're generally called donor-advised funds. And so if you look at step 1, you choose a name or personalize your fund and seed it with a minimum of $25,000 donation or cash or securities. You and others can add additional donations into the future. Okay, so we do an account setup for you, and we add funds to seed at the minimum is $25,000. Number 2, a donation receipt will be issued in your name for that full $25,000. Number 3, invest your donation with the guidance of your Asante advisor. A certain portion can be allocated for charitable purposes each year. Okay, so that's a really important part of the donor-advised funds. In other words, when you put the $25,000 or more in, the idea is to leave enough money in that account every year so it's actually growing value. Then you're harvesting a portion of the profits every year to give to various charities. And so that's when we talk about foundations, that's essentially how a foundation would work. And so you're trying to build or seed enough capital in that plan that it can provide ongoing donations to charities over time. And then 4, make gifts to the charities or causes you wish to support. So Asante's charitable giving program uses donor-advised funds, which are charitable giving vehicles tailored to reflect your personal philanthropic goals and values. As a donor, you and your Asante advisor recommend how to invest the funds within your donor-advised fund and where to make charitable gifts on your behalf. You'll be kept informed on the performance of your investments, and you'll receive updates on the positive impact created by your generosity. So we work with you to set it up. There's a minimum donation of $25,000. You then get back a donation tax slip. So, keep in mind, a lot of people like this because they're getting all these tax slips through the year. So theoretically, you could have one donation slip. You seed the money into your donor-advised fund, and you get one slip back. And you get that slip back for tax purposes. You have control in terms of how the money is to be invested. And then, of course, you can remit money to the registered charities. So again, the idea here, seed the portfolio. You have ongoing control over how most of that money is being invested. A portion then will be allocated to your charities. And like a foundation, you're trying to grow that portfolio, grow yield and return that can then be gifted to the charities every year. This is another schematic. So again, you and your advisor, we make a donation, you get a tax slip, and then you're making annual grants to the various charities that are important to you. So I think one of the biggest advantages of this structure is that it allows for a convenient administrative process where you got one donation, one tax slip. It allows you ongoing control in terms of how that money is to be invested. And then you don't have to remit all that money to the charity of your choice right away. You can make changes. Actually, some people with their donor-advised funds will make specific organizational decisions on what charities they want to benefit from the growth. Sometimes they'll be more thematic. So I just want to give to charities that help orphan children. I want to help charities that do aid work in North Africa. Okay, so you can have a lot of flexibility in terms of how this program is structured. That's the donor advised program. What I wanted to do is just kind of tease you a little bit about that program, and if you want to get more information, don't hesitate to reach out to our office. The next area is using life insurance to create legacy. So there's various things you can do. So first, you can assign a charity as a beneficiary for an existing insurance contract. So you change the beneficiary when that payment's made to the charity. It creates a tax receipt. That tax receipt then can be used to reduce tax that might be paid on the estate. You can make the charity the owner and beneficiary of the existing contract. So in that situation, you're getting immediate tax benefits by assigning the charity as the owner, and as you make ongoing premium payments, you also get some immediate tax benefits for that. You can purchase life insurance for the purpose of creating additional legacy value and estate flexibility. We'll talk about that in more detail. So let's say you were inclined to want to buy a life insurance contract to create legacy. Now, why would you do that? We often see clients do this because they have their own financial assets. They have TFSAs or RSPs or open accounts. They view that asset base maybe more for their own immediate needs, for lifestyle, maybe helping their children or grandchildren. but they do have an aspirational legacy philanthropic kind of motivation. So the nice thing about insurance is you can put an insurance in place, and then you guarantee that there's a tax-free payment to your estate that can then be remitted to charities that way, or it could be done as a direct beneficiary designation. So what I'm showing you here is a $250,000 joint last to die insurance contract. So this is permanent insurance. It's there's no cash values associated with these contracts typically, and this $250,000 death benefit will be paid out for sure as long as the person makes their insurance premium payments. And so it's not if the payout's going to happen, it's just when, and it's a guaranteed term to 100 contract. So you're looking at about $400 a year, or I'm sorry, $400 a month for that kind of insurance. So it begs the question, is that a good investment of money? If I'm trying to create legacy, how does that work out from a return standpoint? Because you can actually look at it that you're not going to get a benefit from it, but your estate will. And so if I'm putting away $400 a month or $4,800 a year, and I live to average life expectancy, what kind of return am I getting for that investment? So let's work backwards a little bit, and I'm just going to take a look at a bit of a schematic that I put together. So again, the premium is just over $4,800 per year, and so what I'm doing now is I'm looking at it as an investment. So let's say you go, okay, well, if I was going to put away $4,800 per year, and I assume that I was going to live for another 25 years. I'm age 65, okay? So I'm looking at 25 years, so I'm going out to age basically 90 in that particular discussion. So 65, 75, 85, 90 years of age. And the question is, if I wanted to have $250,000 delivered to me in 25 years, what kind of return would I have to garner to get that kind of capital down the road? And the reality is the return would have to be 5.6% on an after-tax basis. So every year when I put that $48.24 a year and I invest it, by year 25, if I want to have $250,000 of capital, I'd have to earn 5.6%. Now, if that was a taxable account, assuming an average tax rate of 25%, that means the pre-tax return I'd have to get would be 7%. So the question is, can you invest anywhere today conservatively that's going to get you a 7% return on a pre-tax basis, or an after-tax guaranteed return of 5.6% if you keep paying between now and your age 90? Well, right now, at the time of this taping, no such vehicle really exists for the average investor. And keep in mind that the insurance that pays out at, let's say, age 90 at $250,000 is a tax-free payment. That's why we have to talk about personal savings in the context of either net after-tax return or pre-tax return. So clearly, if I'm just looking at the insurance product from just purely an investment standpoint, if I can get an after-tax return of 5.6% between now and the next 25 years, and then guarantee that my estate gets another $250,000, that's actually a very good investment. So who would do that? Someone who goes, you know what, I want to put some of my cash flow towards this product, or I'll take money from my open portfolio or investments every year to pay for this insurance. That guarantees my legacy plans in place, and then I can spend the rest of my money on things that are important for my spouse and I, or my kids or my grandchildren. Okay, so that's going over a 25-year period. Let's look at a different time period. So if you're a little more cynical around your life expectancy, let's say you live for 20 years. So it's exactly the same calculation. We're going to set aside $48.24 a year. We're going to do it for 20 years. So I'm assuming I'm going to live to age 85. And if I work backwards, again, what would I have to earn in my portfolio between now and my age 85 to have $250,000 in my account? And the return would be 9.1% per year. The pre-tax return equivalent would be 11.38. So again, begs the question, where are you going to invest that you can get that kind of return on your portfolio? So you're actually getting a return of 9.1, 11.38 on a pre-tax basis. So this is one of the reasons why a lot of clients embrace the idea of buying permanent life insurance to beef up the estate. Obviously, you don't do it for yourself. You don't even necessarily do it for your kids or grandchildren, although the insurance could be used for that. But you do it to guarantee that legacy value will be in place. because you just don't know what the future is going to be. You might use a lot of your capital through your retirement years. There might be critical illness that will create a lot of expenses in the later part of your life. And if philanthropy and giving is important, then by having this insurance policy in place off to the side could be a great strategy. This particular slide I think is we're near the end of the presentation. This slide's great because when you talk about our estate and what's going to be there from a legacy standpoint, what you do is you obviously look at your liabilities, you look at any insurance proceeds, any tax owed, other expenses, could be probate fees, that kind of thing, and you have your assets at the top. That equals your estate. When we talk about estate, often we think about the probatable value of your estate. That's assets that get dealt with through your will. For this example, I'm just talking about your total assets. Some assets may go to the estate, some may fall out of the estate if there's beneficiary designations, but there is value that has to be dealt with. This chart's a great chart because again, what we do for our own clients is we do this detailed listing of assets and liabilities, and then this chart outlines what the potential tax liabilities might be upon death. And so obviously, retirement assets could have a tax liability. There could be capital gains on non-registered investments, and there could be a deemed disposition for other investments like cottage property, that kind of thing. So you can see that this particular family had almost $300,000 of tax liability in their estate if something happened to both of them. So that erodes estate value. The reason people will engage in legacy planning, tax planning, and insurance planning is to make sure that all taxes and philanthropic intentions are looked after. Well, I'm hoping that this presentation may pique your interest a little bit. If you are not working with a wealth coach or a retirement coach and you're intrigued about the idea of getting clarity on how to pull all the pieces together, then I encourage you to take a look at our wealth planning process. We have a process called the gap analysis where we take a look at your current planning, identify if there's any planning opportunities or gaps, and then outline strategies that will be helpful to you in the accomplishment of your goals and objectives. We also have resources at our YouTube channel, All Things Retirement. I encourage you to go there. Lots of great information. Also our website at shaunhumphries.com. We have additional information there as well. If you're interested in touching base with us to explore our coaching services in more detail, again, email address shumphries@asante.com, phone information 204-977-8049, and of course again our website shaunhumphries.com. So I wish you all the best in your philanthropic intentions, your gifting intentions, and if you want to reach out to find out more about our wealth planning coaching services, please don't hesitate to do that. You take care. Bye-bye.